Yesterday, the market received somewhat of a shock that the Reserve Bank did decide to raise interest rates. We were surprised as well because we thought that the situation was set up for a rate hike last month and they decided not to. A lot of the rhetoric coming out of the bank since then have been somewhat more dovish from my perspective, suggesting that they would at least wait another month to see the extensive data releases before the December board meeting. But no, the urgency is quite high, and so interest rates have gone up, and the major explanation has been the boost in the terms of trade, which was going to lead to a boom in the Australian economy and push up inflation. With the unemployment rate of 5.1%, only 0.1 above what we call the full employment level, the Reserve Bank is nervous about the inflation prospects. Bear in mind that every other time Australia has had a mining boom, we have dealt very poorly with inflation, but of course they were in the days when we had fixed exchange rates and also in the days when we had a much less flexible labour market. However, the outlook now becomes one very much dependent upon how the banks respond to that rate hike. We've already seen the CBA raise rates by 45 basis points. The Reserve Bank looks at the interest rates very much from the perspective of the private sector rates rather than their actual cash rates. So for instance, if all the banks were to raise their rates by 45 basis points, to me that would mean that there'll be one less 25 hike from the Reserve Bank. So it's very much dependent upon what the banks do. If they all go by 45, then I would say the next rate hike won't be until the June quarter of next year, because I do believe that there are many sectors of the economy, housing, construction, consumer, that are going to take this rate hike pretty badly. So the medium-term outlook for the Reserve Bank cash rate. I believe that next year that the total increase in private sector interest rates is likely to be about 0.5%. Now, if half of that comes from bank adjustments, then the actual cash rate is likely to only need to rise by another 0.25%. The reason I say that is that even though I think the Reserve Bank has a much bigger number in mind, I think that the part of the economy not directly benefiting from the mining boom is going to slow quite substantially. We've seen house prices going sideways. We've got a very cautious consumer on our hands, and business investment that's focusing on the non-mining parts of the economy, I believe will start to respond to a more modest outlook for their sales. So I'd see the cash rate, if we do get a major response from the banks, I'd see the cash rate peaking around 5% next year, and with the next move not being until 2012, when we'll probably get another 50 to 75 basis points. In 2013, we're expecting the economy to slow down under the weight of those high cash rates, but also under a mid-cycle downturn in the global economy and in particular in commodity prices. So 2013-14, I expect to be a period when rates actually come down. As usual, the equity market is going to be very much driven by the developments in the US market. And for the US market, there are a number of huge uncertainties at the moment. What we do know is that the US market generally does pretty well after midterm elections, like extremely well. And particularly if I'm sitting here today, at the time I'm sitting here, we don't know the results, but the expectation is very strong that we will see a Republican victory in the Congress with an outside chance of a Republican victory in the Senate. That will be good for the share market, particularly those companies, those industries that they believe will have less regulation imposed upon them. The only question mark there relates to will the Republicans try to bring down the deficit and so cut things like defence spending a lot more aggressively. For the other big factor, once again US based, will be the US Federal Reserve's decision on quantitative easing. They are going to put more liquidity into the economy. We believe the market is underestimating the degree to which they will do that. So that's going to provide quite a liquidity boost to that economy for most of next year. Once again, a positive for that US share market. The third positive I see is that US corporates have accumulated about $1 trillion in cash on their balance sheets. That's lazy lazy cash. They'll want to put that to work in M&A activities and potentially buying back shares, and that will also give that market a boost. So generally speaking, the key indicator for our share markets looks to be in pretty decent shape for the next 6 to 9 months. However, after that, I expect that with the Australian economy slowing under the weight of the rate hikes and the very high Aussie dollar, and with the US share market realising that the level of the shares just isn't consistent with the pace of growth in the economy, we'll see a substantial correction. So broadly speaking, I'm quite positive about the share market over the next 6 to 9 months, but I think there is a substantial correction sitting out there when the underlying economies fail to keep pace with the strength of the market. On the 2nd of November, we released a 10-year forecast where we look at the key cycles that will impact upon the economies and the financial markets and the commodity markets. So the big cycles are the commodity cycles, the growth cycle in the industrialised world, and the growth cycle in the emerging markets. Broadly speaking, we feel that the growth cycle in the advanced economies will remain very weak for at least the next 2 or 3 years. At the same time, we're expecting to see strong growth in the emerging markets. Now, that will lead to quite a decent continuing improvement in commodity prices. But by about 2013, we're expecting that commodity prices will start to tail off as we get a mid-cycle slowdown in the emerging economies and as strong supply growth runs into modest demand growth. So broadly speaking, we're expecting not to see much improvement in growth in the advanced economies, but continuing upswing in the emerging markets. And of course, China, the most important economy for us, stands tall there. While the Chinese economy is slowing at the moment, we're starting to see some encouraging signs that they're heading towards a soft landing, and that next year they will once again be able to assume that 9% growth.